Today on Forbes, it's not just an AI bubble. Here's everything at risk. Asset bubbles give off a scent. Stocks far outpace earnings. Junk debt looks gold-plated. But no matter how good the rally feels, eventually skepticism arises. The question is whether the smoke alarm is chirping from a dead battery or fire. The S&P 500, as of last week, sat at 6,700, nearly double what it was 5 years ago. The Magnificent Seven tech titans are the rocket fuel. They account for nearly 40% of the index, and they're placing trillion-dollar bets that AI rewires the world. It's not just frothy stocks. Gold is near record highs, as is coffee. Bitcoin, the ultimate risk-on asset, is up more than 130% since it was packaged into exchange-traded funds in January 2024. Amid bidding wars, home prices rise further out of reach for buyers. Even junk bonds trade as if nothing can go wrong. Economist John Kenneth Galbraith wrote that bubbles form the same way every time. A new idea casts a spell. Credit expands. Prices rise. Everyone feels smarter. Then crack. Reality bites, and it all comes crashing down. Galbraith argued the real fuel isn't credit, it's boundless hope and fleeting memory. Each generation convinces itself that this time is different. Nobody rings a bell at the top, of course, and trusted detectors can sound false alarms. The yield curve was inverted from June 2022 to August 2024. That usually portends recessions within 24 months. By that rule, the slowdown should have started already. Yet investors who sold on the signal missed the second strongest start to a rally in half a century. You can blame AI for that too. Deutsche Bank says without spending on AI infrastructure, the US would already be in recession. That's one reason why this market feels off. Perhaps that's why gold is near a record high, something that rarely happens alongside rising stocks. One reflects optimism, the other fear. It could just be a market hedging its bets. Or maybe it's a sign some investors have been smelling smoke before the rest of us. Here are some of the smoke alarms to watch. The Cape-Shiller ratio. The CAPE ratio, created by Nobel Prize-winning economist Robert Shiller, compares stock prices to 10 years of inflation-adjusted earnings. It's now near 40, below the 44 peak of the internet bubble, but well above its 28 average since 1995. Gold. Inflation-adjusted gold prices have doubled since 2023, topping $4,000 an ounce for the first time. Investors are rushing to hard assets, a signal that confidence in paper wealth may be thinning even as markets keep reaching new highs. Margin debt cost as a percentage of GDP. What investors pay to borrow money to buy assets now equals 0.35% of nominal GDP, the highest since at least 1995. As Jim Stack, CEO of Stack Financial Management, says, leverage doesn't cause bear markets, but it does amplify them. The S&P Cryptocurrency Index. The S&P Cryptocurrency Index has more than doubled since 2023 and is back near record highs. Once easy to ignore, crypto is now woven into mainstream finance through ETFs, making its swings more consequential for the broader market. Median home price to income ratio. Median U.S. home prices now exceed 5 times median household income, up from 4 times in the 1990s. Tight supply explains some of it, but it also suggests buyers are stretching and housing may be losing its anchor to reality. High-yield credit spread. The ICE B of A high-yield index spread shows investors accepting abnormally low premiums for riskier debt. When junk bonds trade like blue chips, it's often a sign that markets have grown complacent about the possibility of defaults. Coffee prices. Coffee futures hit $4 a pound for the first time, lifted by droughts, Trump tariffs, and inflation. Commodity spikes like this are a reminder that bubbles aren't limited to Wall Street. Morningstar PitchBook Unicorn 30 Index. The Morningstar PitchBook Unicorn 30 tracks private market heavyweights like OpenAI, SpaceX, and Stripe. It's back to all-time highs after a 50% drawdown in 2022. AI is inflating public markets, but the unraveling may start in private ones. For full coverage, check out Brandon Kokoden's piece on forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.